About this video. This video introduces options trading. An option is a financial product or instrument whose value is based on the value of an underlying asset such as a share. Options trading offers significant potential benefits to investors, but is considered a high-risk investment that carries the risk of making significant losses. Options trading is not suitable for all investors. If you are considering options trading, we recommend that you seek all necessary information and advice before starting to trade. The video is prepared solely for information purposes and does not constitute financial advice. None of the information contained in this video constitutes an offer or solicitation to buy or sell any financial product or instrument, to make any investment, or to participate in any trading strategy.
In the previous session, we covered the 6 elements of an options contract, namely underlying assets, option type, expiration date, strike price, premium, and contract size. We usually say that the value of a stock ultimately depends on the profitability of the company. What then does the value of an option depend on? In this session, we will talk about the factors that affect the value of an option. Let's take a look at Tesla's option chain. At the moment, Tesla's share price stands at $958. We can see that even when call options have the same expiration date, the premiums of the contracts vary greatly depending on the different strike prices. What is the reason behind this? If we scroll to the left, we can see this column, intrinsic value and time value. What are the characteristics of these two numbers? They add up to the latest option price. What is the white line in the middle? For a call, options above the line are in the money, while options below the line are out of the money. How do we tell whether an option is in the money or out of the money? It depends on whether the strike price or the stock price is higher. If the strike price is higher than the stock price, the option is out of the money. If the strike price is lower than the stock price, the option is in the money. If the strike price is equal to the stock price, the option is at the money. A put option, on the contrary, is out of the money above the line and in the money below the line. Now let's look at the intrinsic value and time value columns. We find that both call and put options, when in the money, have intrinsic value. This is the value obtained by immediate exercise. Out of the money options have no intrinsic value, only time value. Here we can see that the current stock price alone determines whether an option is in or out of the money. What does time value mean? There is no strict definition of time value. It is calculated by subtracting the intrinsic value from the option price. It reflects the possibility of profit after the option is purchased. The farther the expiration date is from the present time, the greater the possibility of fluctuations, and therefore the higher the time value. When the option contract expires, the time value returns to 0, which means an out-of-the-money option becomes worthless. As soon as you buy an option, its time value begins declining. 1 month from the expiration date is the critical point. The time value of options expiring within 1 month will decline much faster than before. We find a simple and intuitive law from the option chain. For call options, when the stock price rises, the option price rises. The higher the strike price, the lower the option price. For put options, when the stock price falls, the option price will rise. The lower the strike price, the lower the option price. Whether call or put, the farther away from the expiration date, the higher the option price. Now let's guess intuitively, which option is more expensive, the option of the S&P 500 ETF or the option of Tesla, with the same expiration date and the strike price equal to the stock price? The answer is, of course, Tesla, as its volatility is significantly higher than that of the S&P 500. This introduces a very important factor affecting the option price, implied volatility. This can be understood as the prediction of the fluctuation of the option in the future. The fluctuation direction can be up or down. The higher the option's implied volatility, the more expensive the option price. In the option chain, we can see the implied volatility value. We can see that Tesla's implied volatility is 58.79%, while the S&P 500's ETF implied volatility is only 15.23%. The implied volatility is calculated by using a formula. If the price of an option contract is input and the calculated implied volatility is higher than the actual implied volatility, this means that more people are buying and consequently pushing up the price. Generally speaking, for either call or put, the implied volatility will rise before the release of the company's financial report and then fall afterwards. If we are buyers and see the implied volatility increase, we should be careful. If we are sellers, we may find arbitrage opportunities. So how do we trade options? What are the benefits and risks for buyers and sellers, respectively? Let's talk about all this in the next session.